BlackRock sinking today after reporting earnings. That stock now down 31% from its 52-week high and underscoring a key trend in the market. For more on that, let's bring in Mike Santoli, who's here for a rare appearance, a rare fast money appearance in the flesh.
I mean, why do we deserve this?
Like voted onto the desk or invited or something? I don't know how it works.
Like Survivor.
Yeah.
Good to have you.
But this paradox in the market, Melissa, obviously the asset management stocks have been incredibly weak. The fundamentals haven't been great. And I know Larry Fink was talking about, even for a dominant franchise like theirs, some of the challenges this morning.
We saw huge movement from clients, a lot of churn. And it was just, I think the markets are showing that investors are confused. But overall, because of expense discipline, because of how we've navigated, our revenues were up 18% in our Aladdin business and our technology business. So overall, it was a good quarter. But I was disappointed in our net flows, but very explainable by some large de-risking.
Yeah, and flows are not great across the industry, right? And I think that's just one of the factors that's really been hurting this group. Obviously, the global markets have been weak, so it's not as if everybody's been at record highs in the last month or something like that. But fee pressure, right? I mean, and BlackRock's part of an instrument of that, but people don't see the end of it. So if you look at the stocks year to date, you would never think that this has been a U.S. bull market right now. It used to be they were the best bellwether group you could imagine. They're down between 20 and 40%. These are the big guys there. I basically see the market has decided that they're a disrupted group. Right, that this basically long-term, traditional asset managers, long-only asset managers, I'm not saying they're right, but I think they believe that.
You can only believe that, though, if you think that the markets are going to go one way or the other, right? I mean, I would imagine that in an environment where you think that value stocks may take precedent over growth stocks, that, you know, it's more time for a stock picker, funds should see a benefit, as opposed to ETFs, and funds, of course, have higher fees.
In theory, you should, although the fee pressure is also getting to all types of actively managed products as well. So I do think that's one of the issues. The stocks are cheap. I mean, based on any historical metric in terms of how they have always traded, they used to be a premium to the market. Asset managers were considered kind of like owning a toll booth, you know, and it's actually not been the case anymore. So either the market has it wrong or something's changed.
Well, let's broaden out real quick. Today, notwithstanding, Goldman Sachs and Morgan Stanley have been trading awful now for the last year or so. Are they getting caught up in this as well?
I mean, I think you could argue the market also thinks they're kind of disrupted, or at least they're not levered the way they used to be to a strong market and a strong economy. And by the way, Goldman Sachs and Morgan Stanley, in large part, are asset managers, right? I mean, Goldman has liked to emphasize the fact that Goldman Sachs Asset Management is a much bigger part of the mix than it ever was. So the market's not going to give them any credit for that in this environment.
Mike, thank you. Okay. You're always welcome here.
Yeah, you don't need to be voted on. Just bring yourself.
Like
as long as the Hyperloop from the New York Stock Exchange can get me here.
Mike Santoli. Well, options traders are betting on a bounce for one asset manager. Brian Stutland's joining us now from the CME in Chicago to break it down. Brian.
Well, not BlackRock, but Blackstone. When we look at the put activity in there, it was pretty huge today. We're trading 1.5 times that at calls in Blackstone. What's interesting is typically it's 2 times the amount of calls versus puts, not puts being skewed the other way. So at first glance, it looks a little rough. But what we saw was a seller of 2,500 November 33 puts for 41 cents. They were selling insurance, not buying put insurance. And what that basically meant is the trader was picking a level that they're willing to get long the stock, basically break even at 32.59, capturing that 41 cents. And with earnings coming up here on Thursday for Blackstone, they're expecting about 40% year-over-year growth. This trader is basically saying if the stock drops after earnings, I'm willing to buy the stock down at that $33 level and play possibly to the upside, at least capture some premium here. I love this trade. If you want exposure to private equity, Blackstone's, that's that area to get that private equity exposure. And I love this in this kind of growth environment that we're still seeing, somewhat low interest rate environment. Seems like a nice play.
All right, Brian, thanks. Brian Stutland joining us from the CME in Chicago. For more options action, you can check out the full show. That's Friday, 5:30 p.m. Eastern Time.